The investment thesis for Subsea 7, SUBC, is predicated on a convergence of three powerful market forces: sustained cyclical recovery in the traditional offshore energy sector, strategic dominance in the emerging renewable infrastructure market, and a transformative corporate action. Subsea 7's core subsea, umbilicals, risers, and flow lines (SURF) business is experiencing robust pricing power driven by tightening supply for high-specification assets, leading to superior margin expansion. Concurrently, the strategic diversification into the high-growth offshore wind sector via Seaway 7 provides structural growth exposure. Crucially, the proposed 50-50 merger with Saipem, expected to create the global EPCI leader, Saipem 7, acts as the primary near-term catalyst. The combination promises substantial synergistic value capture, reduced capital structure risk, targeting investment-grade rating, and significant immediate cash value transfer to existing Subsea 7 shareholders via pre-closing dividends. Current market valuations are deemed insufficient to fully reflect the combination of cyclical tailwinds, operational momentum, and realized merger value. 1.2 Key financial and operational highlights. Subsea 7 is capitalizing on the favorable market environment, transitioning volume growth into exceptional profit growth, evidenced by expanding EBITDA margins and a high-quality backlog. 1.3 Conclusion and rating justification. The analysis suggests a strong outlook supported by structural supply constraints in high-specification assets. While the stock currently trades at a premium to peers based on trailing earnings multiples, this premium is justified by superior growth demonstrated by a growth score of A and markedly higher and more predictable margins. The proposed combination with Saipem provides further earnings acceleration through $300 million in annual synergies, transforming the company into a scaled, financially robust global leader, Saipem 7. The recommendation is buy, targeting the analyst consensus average of $229.55, which represents a potential upside of approximately 25.50%. I. Company and segmental analysis, dual-engine growth strategy. 2.1 Subsea 7, a global offshore energy services leader. Subsea 7 SA is established as a Tier 1 contractor specializing in the engineering, procurement, construction, and installation (EPCI) of subsea infrastructure for the offshore energy market. The group leverages its comprehensive fleet of highly specialized vessels, robust onshore infrastructure, including pipeline spool bases and fabrication yards, and significant engineering expertise to manage complex projects globally. The company's strategic objective is to create sustainable value by delivering solutions that support both the continuous evolution of lower-carbon oil and gas developments and the rapid expansion of offshore wind. 2.2 Operational segmentation, Subsea and Conventional. The Subsea and Conventional business unit represents the core foundation of the group, primarily deriving revenue from the fossil fuel sector. This segment focuses on the full life cycle of subsea field development, including the highly specialized SURF market. Market dominance and competitive moat. The Subsea and Conventional business is strategically positioned within one of the most compelling subsectors of traditional energy services. The market for enabling deepwater pipelay vessels is concentrated among a stable landscape of only 3 Tier 1 players. Subsea 7's competitive advantage is derived from its fleet of global enablers and its emphasis on integrated service delivery, such as its SPS SURF offering, which has resulted in $8 billion in contracts awarded through the Subsea Integration Alliance since 2016. The complexity and technical requirements of deepwater projects necessitate high-specification assets and proven execution capability. The successful completion of projects, such as the $1.2 billion fast-track Sakarya Phase 1 development in Turkey, which utilized approximately 1,000 days of the largest pipelay vessels, confirms SUBC's specialized operational capacity in complex environments and new geographies. This specialized execution capability leads to clients increasingly approaching Subsea 7 for sole source developments to minimize the tendering phase and accelerate project timelines. Decarbonization evolution and deepwater resilience. While anchored in fossil fuels, the Subsea and Conventional segment is actively contributing to decarbonization. The group is facilitating the continuous evolution of lower carbon oil and gas developments. Furthermore, it is leveraging its existing subsea fleet for emerging energies, exemplified by the completion of the Northern Lights carbon transportation and storage project in Norway. Such projects offer new growth streams with minimal associated capital investment, utilizing assets already owned. The continued demand for deepwater developments is supported by their advantageous carbon intensity profile, primarily due to the efficiency and scale they offer in targeting very large reservoirs. Unlike shallow water projects, deepwater fields require massive long-term infrastructure investment, SURF. The inherent efficiency means these projects remain economically viable even if short-term oil price volatility occurs. This structural characteristic ensures that demand for high-end SURF services is less cyclical and more insulated from immediate commodity price fluctuations, underpinning the high revenue visibility provided by the current backlog. 2.3. The Offshore Wind Pivot, Seaway 7. Seaway 7, now fully consolidated and wholly owned by the Subsea 7 Group, is the dedicated vehicle for accessing structural growth in the energy transition market. Market leadership and asset advantage. Seaway 7 is recognized as a market leader in fixed offshore wind, having contributed to 11.9 gigawatts of cumulative installation capacity across Europe, Asia, and the US. The company offers comprehensive services, including full EPCI, engineer, procure, construct, and install, or T&I, transport and install scopes. The competitive positioning of Seaway 7 is heavily reliant on its high-capacity vessel fleet. The delivery of new-build assets, such as the Seaway Alpha Lift and Seaway Ventus, added in early 2024, is vital. This investment preempts future supply constraints. Turbine sizes have increased rapidly from 4 megawatts to 16 megawatts, with market trends pushing toward 20 megawatts. This scaling directly increases the volume and weight of necessary foundations, requiring greater lifting capabilities from installation vessels. Given the long lead time required to deliver new vessels, Subsea 7's commitment to a long-term view and investment in these sophisticated assets provides a significant, sustainable competitive advantage in a market where specialized vessel capacity is the limiting factor for project execution. Strategic risk management and profitability. Management has focused on driving profitability in the renewable segment through disciplined risk management. The 2024 strategy emphasized increasing the selectivity of bidding activity to ensure a fairer balance of pricing and risk. This decisive action successfully drove an improvement in profitability and enhanced predictability in project execution, positioning the offshore wind business for continued value creation. The company begins 2025 with confidence in capturing a fair share of the growing market while delivering acceptable profitability levels. 3. Industry dynamics and macroeconomic context. 3.1. Upstream CapEx cycle analysis. The upstream oil and gas market is undergoing a structural recovery cycle supported by long-term planning assumptions from major clients. Commodity price volatility versus investment stability. While Brent crude oil prices fluctuated between $75 and $85 per barrel in 2023, clients' investment decisions for major deepwater projects are generally based on long-term outlooks that remain supportive of capital expenditure. This structural buffer is critical for a high CapEx EPCI provider. However, the market is subject to macroeconomic pressures. Forecasts suggest a cooling of commodity markets, with Brent crude spot prices expected to fall to an average of $62 per barrel in the fourth quarter of 2025 and further to $52 per barrel in the first half of 2026, driven primarily by projected global oil inventory builds. The long-cycle nature of deepwater SURF services offers a crucial financial buffer against such short-term commodity price drops. The nearly $12 billion backlog represents revenues locked in under contracts secured at favorable rates during periods of strong demand. This high backlog visibility insulates Subsea 7's near-term earnings trajectory from the anticipated decline in oil prices forecast for 2026, mitigating the immediate operational impact. Furthermore, the strategic imperative behind natural gas, particularly the need to backfill existing LNG capacity for energy security, ensures continued robust demand for subsea infrastructure, reinforcing the stability of the core market.
3.2. Offshore wind growth trajectory and policy support. The growth of offshore renewables is underpinned by strong policy mandates, particularly in Europe. The European Green Deal emphasizes decarbonization and sets a critical objective to reduce net greenhouse gas emissions by at least 55% by 2030, heavily prioritizing the development of Europe's offshore wind potential. The market landscape is maturing. While some oil and gas majors have scaled back offshore wind investments, specialized developers and infrastructure funds are increasingly stepping in to finance projects. This shift stabilizes the market and ensures continued project development even as developers actively rebalance risk and offload capex. The aforementioned technological trend toward massive turbine sizes 16 MW and above standardizes the demand for the specific high-capacity vessels that Subsea 7 through Seaway 7 has invested in. This confluence of supportive policy and increasing technological requirements creates a favorable structural dynamic for high-end contractors. 3.3. Supply-demand tension in high-specification assets. Favorable competitive dynamics characterize the Tier 1 SURF subsector primarily due to the limited supply of specialized assets. This structural constraint translates directly into quantifiable financial leverage for Subsea 7. Operational data from the offshore support vessel (OSV) industry confirms this tightening. High-tier vessel utilization jumped significantly to 76% in the first 9 months of 2025, up from 59% the previous year, with average charter rates rising about 5% since late 2024. Utilization levels nearing 75% typically transfer pricing power from the clients to the service providers. This leverage is the explicit driver behind Subsea 7's ability to selectively tender projects, a strategy that yielded the observed 370 basis point expansion in its EBITDA margin. By rejecting low-margin work and focusing only on projects with favorable risk-reward characteristics, management is effectively converting structural asset scarcity into superior profitability and high returns on capital deployed. The outlook suggests demand will strengthen further in 2026 and 2027 as oil and gas projects move into the development and production phases, maintaining upward pressure on day rates for high-specification assets. IV, Financial Performance and Operational Momentum. 4.1. Revenue and EBITDA Trajectory 2023-2025. Subsea 7's financial results demonstrate a clear acceleration in performance driven by the ongoing market recovery and effective contract execution. Revenue increased by 14% year-over-year in 2024, reaching $6.8 billion, up from $6.0 billion in 2023. This growth trajectory continued into 2025, with Q2 revenue reaching $1.8 billion. The expansion in profitability has been even more pronounced. Adjusted EBITDA surged by 52.7% in 2024 to $1,090 million, compared to $714 million in 2023. This momentum carried through to Q2 2025, where adjusted EBITDA grew 23% to $360 million. 4.2. Margin expansion and profitability drivers. The most compelling financial indicator of Subsea 7's successful strategy implementation is margin expansion. The adjusted EBITDA margin reached 16% for the full year 2024 and surpassed 20% in Q2 2025, marking a 370 basis point improvement. This dramatic improvement reflects a combination of late-cycle exposure to the subsea market recovery and the solid structural growth in offshore wind. Critically, this expansion is explicitly linked to management's proactive strategy of increasing the selectivity of its bidding activities. By focusing on maximizing risk-adjusted value creation, Subsea 7 secures better contract terms and lower inherent execution risk, allowing volume growth to generate disproportionately higher profit growth. This performance contrasts sharply with industry peers, who report lower and more volatile margins, such as Aker Solutions, which forecasts 2025 EBITDA margins, excluding OneSubsea, between 7.0% and 7.5%. 4.3. Backlog quality and revenue visibility. The group's forward visibility is exceptional, securing its multi-year earnings trajectory. The backlog stands robustly at nearly $12 billion.
New order intake has been vigorous, reaching $8.2 billion in 2024, up from $7.4 billion in 2023. In Q2 2025 alone, order intake was $2.5 billion. This dynamic translates to a Q2 2025 book-to-bill ratio of 1.4x, indicating that demand for Subsea 7 services significantly exceeds its current rate of project completion. This ensures high revenue visibility, covering over 90% of projected revenues for the coming year. Furthermore, management notes that the mix of long-term contracts within the backlog is shifting towards those won in a favorable environment, underpinning confidence in future profitability. Historical financial performance momentum. Metric: Q2 2025 USD, 2024 USD, 2023 USD. Growth driver. Source: revenue, $1.8 billion, $6.8 billion, $6.0 billion, market recovery, EPCI project execution. Adjusted EBITDA, $360 million, $1,090 million, $714 million, selective tendering, operational leverage. EBITDA margin, greater than 20%, 16%, NA, favorable contract mix shift. Order intake, $2.5 billion, $8.2 billion, $7.4 billion, strong client capex and demand. Book-to-bill, Q2, 1.4, NA, high demand and realized pricing power. 4.4, capital expenditures and fleet strategy. The group maintains strict discipline regarding capital deployment. Its fleet strategy is designed to balance resilience and agility, relying on ownership of 29 highest specification vessels, global enablers, while chartering 12 smaller construction vessels for support. This approach ensures that capital is concentrated on assets that are key to winning and executing major projects. Given the long lead time required for new vessel delivery, Subsea 7 prioritizes a long-term view of market trends. Reinvestment opportunities are approached conservatively, with a focus on maintaining favorable supply-demand tension for its specialized solutions. V. Balance sheet and capital allocation. 5.1. Liquidity and debt structure. Subsea 7 maintains a balance sheet strength that is crucial for its through-cycle resilience and essential for clients' confidence in their ability to deliver complex, multi-billion-dollar projects. As of March 31, 2025, total equity stood at $4.4 billion. Total borrowings were $691 million, a decrease driven by scheduled repayments. The 2024 net debt amounted to $602 million, which includes lease liabilities of $455 million. The inclusion of lease liabilities, IFRS 16, provides a more comprehensive view of the group's financial obligations. 5.2. Leverage metrics and financial resilience. Subsea 7's conservative leverage profile is a key strategic advantage. The 2024 net debt to EBITDA ratio was exceptionally low at just 0.6 times. This low leverage minimizes interest expenses and reduces overall capital risk, granting the company significant financial agility to seize opportunities. In the context of the proposed merger, this robust balance sheet provides a stabilizing factor for the combined entity, Saipem 7, and is instrumental in achieving the shared goal of attaining an investment-grade credit rating. 5.3. Shareholder return policy. Subsea 7 has a demonstrated commitment to shareholder returns, having distributed over $2 billion in dividends and share repurchases over the past 12 years. Recent returns include $250 million distributed in 2024, with a proposed dividend of $350 million scheduled for payment in 2025. The capital allocation policy is set to continue after the proposed corporate transaction. Following the completion of the combination, the merged entity, Saipem 7, is expected to distribute to shareholders at least 40% of its free cash flow, calculated after the repayment of lease liabilities. This provides a clear, quantitative, long-term framework for capital returns based on operational performance. V. Standalone valuation and peer benchmarking. 6.1. Absolute valuation metrics. Subsea 7's valuation reflects a market expectation of sustained high growth and strong profitability, particularly when viewed against traditional multiples. The stock trades at a PE ratio ranging between 20.38 and 21.3x.
Its enterprise value to last 12 months EBITDA multiple is 6.2x. Analyst consensus places the average 12-month price target at $229.55. Based on recent trading prices, this consensus implies a potential upside of approximately 25.50%. Analysts have assigned the stock a high growth score A, affirming the strong financial health and growth prospects.
6.2. Peer Group Multiples Comparison. A comparative analysis against key industry peers in the EPCI and energy services sector indicates that Subsea 7 commands a notable valuation premium. Subsea 7's PE multiple, 21.3x, is significantly higher than both its merger partner, Saipem, 13.8x, and the broader Norwegian energy services industry average, 6.3x. Similarly, the EV/EBITDA multiple, 6.2x, is elevated compared to Aker Solutions, 2.3x, and Saipem, 4.2x. 6.3. Reconciliation of premium valuation. The market's willingness to assign a premium multiple to Subsea 7 is justified by several material qualitative and quantitative factors that distinguish the company from its peers, many of which are struggling with execution or structural issues, e.g. Petrofac's negative EV/EBITDA. The primary justification lies in the quality and profitability of the earnings stream. Subsea 7 has consistently demonstrated superior growth prospects, growth score A, and achieved significantly higher EBITDA margins, surpassing 20% in Q2 2025, a level unattainable by many competitors in the EPCI space, such as Aker Solutions' 7.0 to 8.8% target. This strong operational performance results directly from the successful implementation of the selective tendering strategy, which translates asset scarcity into exceptional pricing power. Furthermore, the high visibility provided by the nearly $12 billion high-quality backlog substantially reduces earnings uncertainty, warranting a higher multiple compared to companies whose earnings are more exposed to spot market volatility. The strategic exposure to high-growth offshore wind further mitigates risk associated with pure-play hydrocarbon service providers, reinforcing the belief that the current premium valuation is warranted. 7. Deep Dive Analysis of the Proposed Saipem Merger, Saipem 7. The proposed cross-border merger of Subsea 7 into Saipem, renaming the combined entity Saipem 7, is the most important valuation driver for the stock, transforming the corporate profile and financial trajectory of the group. The transaction is anticipated to be completed in the second half of 2026. 7.1. Strategic Rationale and Synergy Potential. The core rationale for the merger is the creation of a global leader with the requisite scale to address the increasing magnitude and complexity of modern offshore energy projects across oil and gas and renewables. The companies possess highly complementary geographical footprints, vessel fleets, and technical capabilities, facilitating a broader, more efficient service offering. Financial scale and synergies. The combined Saipem 7 entity will achieve massive scale, boasting a pro forma backlog of approximately €43 billion and LTM revenue of nearly €20 billion as of September 30, 2024. Crucially, the transaction is expected to unlock €300 million in annual cost and capex synergies on a run rate basis, projected to be achieved by the third year following completion. Synergy breakdown. Operational expenses, fleet optimization, procurement, approximately €200 million. Capital expenditure, optimized allocation across complementary fleet, approximately €75 million. Process efficiencies, approximately €25 million. These operational synergies are driven primarily by improved fleet optimization, including better utilization and geographical positioning of vessels, and enhanced procurement through longer charter periods and improved supplier terms. The goal is to maximize the deployment of global enabler assets, reducing the idle time associated with assets serving standalone global portfolios. 7.2. Transaction Structure and Shareholder Economics. The transaction is structured to result in a 50-50% pro forma ownership split between existing Saipem and Subsea 7 shareholders. Subsea 7 shareholders are set to receive 6.688 new Saipem shares for each Subsea 7 share held. The structure is supported by the key reference shareholders of both companies, including CM Industries, Subsea 7's largest, and Eni and CDP Equity, Saipem's largest. 7.3. Value transfer to SUBC shareholders, pre-closing distributions. A significant component of the transaction value for Subsea 7 shareholders is the guaranteed near-term cash distribution, which effectively de-risks the investment and enhances the internal rate of return, IRR, of the investment in the merged entity. Subsea 7 will distribute an extraordinary dividend of $450 million immediately prior to the completion of the merger. Furthermore, a dividend of $105 million related to a permitted business divestment will also be distributed to shareholders prior to closing. This immediate value transfer, totaling $555 million, provides shareholders with a high-confidence cash return up front, offsetting potential execution risks or delays associated with the integration process leading up to the anticipated H2 2026 close. 7.4. Pro forma Saipem 7 financial profile. The merger is expected to result in a global organization comprising over 45,000 employees. The pro forma balance sheet of Saipem 7 is designed for strength, targeting an investment-grade credit rating. The pro forma leverage ratio of 0.6x net debt EBITDA, post-IFRS 16, post-dividend, is structurally sound. Subsea 7 contributes a healthy financial profile to the combined entity, which is expected to facilitate the achievement of investment-grade status, lowering the future cost of capital and increasing financial resilience. 8. Investment risks, opportunities, and final valuation. 8.1. Key investment risks. The investment is subject to several risks inherent to the EPCI sector and major corporate transactions. Merger failure or delay. The completion of the merger is not anticipated until the second half of 2026. Failure to obtain necessary regulatory approvals or shareholder dissent would remove the major valuation catalyst and the promised shareholder distributions. Furthermore, integrating two massive, complex vessel fleets and global organizations presents material integration risk, potentially delaying the realization of the projected synergies. Implementation costs are also substantial, estimated at between 200 million and 270 million euros. Project execution risk. The core business remains vulnerable to the inherent risks of engineering, procuring, and constructing multi-billion-dollar offshore infrastructure. An inability to accurately estimate project costs or respond effectively to operational and contractual risks could negatively impact financial performance and legal liability. While SUB's selective tendering minimizes this, the risk remains acute for highly complex deep-water programs. Commodity price sensitivity. Although the extensive backlog provides insulation, a sustained deep slump in oil prices, exceeding the 1H 2026 forecast of $52 per barrel, could significantly curb future final investment decisions, FIDs, and reduce new order intake from clients. Renewables market dynamics. The pace of the energy transition remains uncertain. Challenges related to project economics and permitting have caused some oil and gas majors to scale back wind investments. Although policy support, like the European Green Deal, is strong, any significant deceleration in offshore wind project awards could slow growth in the Seaway segment. 8.2. Strategic opportunities. Expanded decarbonization services. Subsea 7 is actively positioning itself for the next generation of offshore energy. Leveraging its existing subsea fleet for carbon capture and storage offers new, low-investment growth streams, as demonstrated by the Northern Lights project. Furthermore, investments in floating wind technology and cable lay projects position the company to capture value from this nascent, high-potential offshore sector. Full synergy realization. The target of 300 million euros in annual run rate synergies represents a powerful high-margin boost to the combined earnings profile. Successfully achieving these targets would accelerate earnings growth significantly beyond standalone projections and robust support for the projected investment-grade rating. Tier 1 dominance. The merger consolidates two leading Tier 1 contractors, achieving necessary global scale and diversification that reduces operational volatility and enhances competitiveness against major engineering firms globally. 8.3. Final valuation, reconciliation, and conclusion. A comprehensive valuation of Subsea 7 requires a sum-of-the-parts approach, integrating the operational momentum with the value accretion from the impending corporate transaction. Standalone operating value. Based on operational performance, 20% plus EBITDA margins in Q2 2025, and backlog quality, the premium valuation relative to peers is justified. Applying a peer-adjusted EV/EBITDA multiple 6.5 to 7.0 to the projected 2026 EBITDA, incorporating current run rates and backlog conversion, yields a strong intrinsic value. Merger distribution value. The present value of the guaranteed $555 million pre-closing cash distributions significantly de-risks the investment, providing substantial immediate cash return that must be factored into the investment's cost basis. Synergy value. Capitalizing the $300 million run rate synergies, discounted back to the present, net of the $270 million implementation costs, adds significant accretive value to the combined entity's value. Conclusion. Subsea 7 is a compelling investment opportunity defined by its position in the cyclical upturn of the deepwater market, its unique asset-based competitive advantage in offshore wind, and its robust balance sheet. While the standalone business is financially strong, the proposed merger with Saipem is transformative, creating a dominant EPCI entity with superior scale, financial strength, targeting investment grade, and substantial, quantifiable synergy potential. The combination of immediate cash distribution to shareholders and significant future earnings accretion justifies a conviction buy rating, with the stock currently undervalued relative to its forward, fully synergistic earnings potential as Saipem 7.